The world's economies and markets are being transformed by mega forces, especially artificial intelligence. As we track this transformation into 2026, the three investment themes in our 2026 outlook are 1. Micro is macro. 2. Leveraging up. And 3. Diversification mirage. First, micro is macro. Companies' capital spending ambition tied to the AI build-out are huge, big enough to have a macroeconomic impact. The overall revenues that AI eventually generates could justify the spend on a macro level, but it is unclear how much tech companies will capture. We think they will adjust plans as visibility on potential revenues and energy constraints improve. Second, leveraging up. AI spending comes first, benefits and revenues are likely to only come later. That creates a need for long-term financing, making greater leverage inevitable. We expect companies to keep tapping public and private credit markets, creating opportunities for investors. Third, diversification mirage. In markets driven by just a few forces, allocations made under the guise of diversification may now in fact be big active bets. Investors should be ready to pivot quickly. We think traditional diversifiers like long-term treasuries will no longer be the reliable buffer they once were. We prefer exposures with their own sources of returns, such as private markets and hedge funds. The bottom line is, we stay pro-risk and think the AI theme will remain a key driver of equity returns. We see an environment ripe for active investing.
Micro is macro because the AI story is the macro story that we're talking about. And Credo, which I had never heard of until this morning, is actually centered to a lot of the data center connectivity. So how are you seeing the transformation of this AI story in 2026 and how to play it amid a really competitive landscape?
It is very complex. So our outlook is titled Pushing Limits, and it is about making sense of large numbers. What do you need to believe to justify the spending of this amount of dollars going into AI build out, and also how to think about investing when transformations of these scales are happening around us and there is no such a thing as neutral stance anymore. So if we look at the large numbers of CapEx forecast, credible forecast takes us to $8 trillion by the end of this decade. The current forecast for big tech companies in terms of incremental revenue do not justify this amount of spending yet. But the potential of AI goes beyond existing business lines. So we're talking about AI application in non-tech sectors. So there is a path for us to get to a place where this spend can be justified. You gotta believe that we can break out of the historical growth trend of close to 2%. It has never happened before, but it is now possible. But also we need to believe that tech companies get to keep and potentially increase their revenue share, which is possible too given compute centrality. So we're talking about unprecedented spend at this moment. We gotta believe in unprecedented things happening to justify, but it is possible to see that happening because of the accelerating pace of innovation that AI brings, but which is why we stay risk on heading into next year. But signposting is very, very important.
Well, I just think about risk on meaning one thing in 2025 and possibly meaning something else in 2026. Does it mean staying with the winners so far, or does it mean betting on the possible growth in other areas with a sort of broadening out in the ecosystem, the adopters, not just the generators of some of this new technology?
I think concentration first, diffusion later. We're still in the build-out phase of AI. If you look at the latest round of kind of tech correction and broader market nervousness, by the way, I'm very happy to be releasing the outlook today instead of yesterday. But there is already greater differentiation among kind of the tech performances. You have companies like Alphabet that are actually holding up well because of the TPU talk, because of the model. You have companies like Oracle coming a bit more under a bit more pressure because of negative free cash flow as well as greater indebtedness. So greater differentiation is likely here to stay, and we do believe concentration as we figure out how the revenue generated in the future are going to be split is important.
How do you identify new winners when it comes to AI?
That's a great question. So as I think about signposting for navigating the AI trade, we have to look at the financing gap of companies. We have to look at free cash flow and revenue of companies to understand if these big tech companies are still believing in each other and spending in each other. I'm talking about circular spending in terms of chips and data centers. But also we need to understand if there is, because at the end of the day, it comes down to external demand. Is this spending generating external demand? Are consumers buying and paying for AI services? Are new companies also paying for tokens? So we need to see all of this happening to kind of see the momentum going. And then the last thing I would say in terms of identifying new winners of AI is to look at the profile of revenue, because existing business lines may not justify this huge amount of spending anymore. We want to see new revenue streams being created. So we're talking about the intersection, the coming together with tech and other sectors, for example, pharmaceuticals. And then we have to understand when new revenues are being created, who the winners are going to be, because right now it's still highly uncertain. Is it going to be the provider of compute and models, or is it going to be the provider of IP and data? And I think that is still kind of out.
In your research, you also talk about the next phase being about energy and solving for bottlenecks. Is that a 2026 story, or is that actually more 2027, 2028?
I think it is a present story, and it is a present story that goes into the future. So we actually frame the constraints facing AI build-out along the dimension of energy and physical, and financing constraint and political constraint. So the energy constraint is already happening now, and ultimately the assessment of these constraints together with the profitability of what is spent is going to determine if these companies are going to stick to their commitment, or if they may want to dial back a little bit.
Jim Zelter was on earlier this morning, and he was talking about how going forward, there seems to be a disagreement between the bond and stock market, where people in the stock market are expecting an acceleration in corporate profits. They're expecting a reacceleration in the global economy. And the bond market is looking for Fed rate cuts and just this sort of disinflationary environment. Do you see one as being right and one as being wrong in the idea of either a reacceleration with inflation, or potentially a less robust backdrop with that disinflationary backdrop that people have been looking for?
I think it has been a while that stock market and bond markets may not be telling the same story. So the disconnect between the two is not highly unusual. I would also say that as we think about next year, we do like equities. We do like U.S. equities in particular. We think earnings would continue to carry equity momentum forward. And we also are bringing down our conviction to long duration treasuries to now underweight, because we do think that even though the macro environment may support the Fed to keep cutting, considerations for fiscal trajectory will ultimately come to bind over the horizon of 12 months, which is why we expect term premium to push higher, and we are underweight long duration treasuries. We prefer to click the income and coupon on the front end and the belly of the curve. And for the same reason, we have been underweight JGB, Japanese government bonds, and we go even more underweight because of the fiscal dynamics.
And what we saw over the past couple of trading sessions, I'm just wondering whether you're underweight U.S. assets as well, whether you see the U.S. still being the bastion of growth, particularly when it comes to this AI trade, or if you see it migrating elsewhere, especially as more focus turns to places like China.
Well, we have the overweight in U.S. equities, and we certainly expect, because of the key theme of micro becoming macro, actually AI capex spend supporting U.S. growth. It's already kind of, its contribution to U.S. growth is at 3 times the historical level. So it's tracking this year already at elevated levels. We expect that to continue even if labor market cools down. So micro supporting macro is something that we expect to happen and continue for next year. But there is room to broaden out, and here I'm specifically talking about kind of even markets like Europe that doesn't have as much concentration in technology as the US. But if you look at financial as a sector, they are actually ripe for disruption from greater integration of AI, and our investors are quite excited about that opportunities as well. We've been overweight European financials, and we stay overweight European financials.